This is a video on investor inertia, a primary problem mitigated by the PolarisInvesting.com website. Other videos are available on the Polaris Investing YouTube channel. This video is brought to you by PolarisInvesting.com, a site for creating defensible valuations. As a reminder, valuation is a craft requiring skillful balance of past facts with future possibilities. Investor inertia is primarily driven by regret from negative outcomes. Regret is especially intense when an action is taken that is an unusual departure from a normal pattern. Behavioral scientists call this errors of commission. Doing nothing avoids blame. This brings in mind a quote credited to John Kennedy, namely, "Success has many fathers, but failure is an orphan." The possibility of negative outcomes exasperates decision-making under uncertainty, particularly in ambiguous situations where probabilities are unknown. Investors must balance regret from being invested in a down market against the regret from not being in the market during a recovery. Thus, investors seek out advice that typically just adds to their uncertainty. Compounding the challenges involved with investing is the outcome investments are time sensitive. An investment that underperforms in the short term often outperforms in the long term. There is a lack of strong causal correlation between short-term indicators, like price, and long-term outcomes, namely wealth accumulation. This causes investors to focus on what little information is currently available, particularly price. So the combination of uncertainty, lack of relevant immediate feedback on progress towards long-term goals, and outcomes far into the future results in investor inertia. With uncertainty being a major component of investor inertia, I'm going to now discuss the main sources of investor uncertainty, namely advice coming from the mutual fund industry, discount brokers, and analysts. So starting off with mutual fund, the industry wants investors to think they are incapable of investing in individual stocks. And the best thing for them to do is just buy their funds and let the fund managers decide what individual investments to make. In this industry, assets under management is a key driver of mutual funds, and then charge the investors a flat fee of around 2%, plus some with front load fees, back load fees, but pretty high fees when you consider that the benefit derived from the funds typically generates at most 7-8% a year, and then possibly the incremental return that the mutual fund is actually earning over what the novice individual investor would be able to do on their own is at most a couple of percent. So when you're charging 2% and only the benefit is at best 5%, you're getting into 30-40% cost of the benefit. So mutual funds, looking at it that way, are very expensive. Discount brokers want investors to think they are capable of investing in individual stocks. But the brokerage industry has recently gone through significant change, with trading costs now essentially zero. Brokerage firms now make money from payment for order flow and the spread on cash reserves, although it is questionable whether trades are actually free when order processing companies are making money off the bid-ask spread. All right, another source that individual investors seek out is the opinions from analysts. But analysts are far from perfect. The forecast on average coming from analysts for any given stock is off by as much as 30%. Typical forecasts are just current price plus around 20-25%. Analysts tend to be very optimistic. They have 6 times more buy recommendations than they have sell. They rarely report negative earnings. As you can see here, less than 1% of the time, when actually in a given reporting period, around 20% of companies report negative earnings. There's 2 types of analysts. There's sell-side analysts and buy-side analysts. And most of the information available out there on the internet for free is from sell-side analysts. And they're more focused on persuasion rather than accuracy. They spend the majority of their time marketing or selling stocks than doing the actual research. Bottom of the picture you're currently looking at shows the recent history of Microsoft stock and then forecasts going forward from 30 different analysts. And the range of forecasts are all the way from around $75, which is about a 30+% drop from the current price, up to $160, which is about a 30% above the current price. So as an individual investor looking at that kind of information, it's really of little value to have a range going from plus to minus 30% over the next year. So no wonder there's inertia as investors look around for information to make investment decisions on, because the information they find, particularly from supposed experts, varies. Well, we assume that somehow the investor can actually manage to make a decision. It's very difficult to stay the course. As mentioned earlier, investing outcomes lack strong causal correlations with short-term indicators of long-term outcomes. So to fill the void, investors tend to focus on price. But as shown in the slide being shown now, is that, and shown in many other videos on the Polaris YouTube channel, is the straight line is a representation of valuation over time, and then the oscillating line is price movements over time. And prices tend to rarely be equivalent to valuation at any given time. So the saying is that average is not the norm. If you think of valuation as kind of the mean reverted value or price that you expect a stock to get to, it rarely happens. And so an individual investor has to be willing to look wrong, and sometimes extremely wrong compared to the current price, for long periods of time. It's easy to lose confidence in your valuation when constantly comparing it to the current price. The price is virtually impossible to ignore because price information is ubiquitous, from smartphone apps, computer alerts, and excessive newspaper, radio, and TV coverage. It is interesting to note that for a typical stock, an average of less than 0.5% of outstanding shares are traded in a given day. And around 33% of U.S. stocks don't even have a single share trade in a day. This means that 99.5% of stock owners do not take action based on the current price, leaving the current price to be determined by just 0.5% of stock owners. But as price diverges from valuation, it's difficult for all investors to remain convicted and stay the course. To demonstrate just how impactful constant access to price information is on investors' conviction, Joel Greenblatt ran an interesting experiment in one of his classes at Columbia University several years ago. Joel Greenblatt, by the way, is a very well-known hedge fund manager that also teaches at Columbia University. But he ran this experiment where he simply asked the students in his class how many jelly beans were there in a jar, and he had them write down their answer and hand them in. He then had them announce how many jelly beans they thought were in the jar, and gave them the option of changing their guess that they actually wrote down on the piece of paper and handed in. And then when all the students finished announcing their guesses, an average was taken of the verbal estimates and then compared to the average of the written down estimates. And the students were surprised that there was quite a difference. The average written estimates were within 5% of the actual amount of jelly beans in the jar, whereas the average announced estimates were substantially off. Well, having the students announce their guess is very similar to in the investment world of having prices announced as someone makes a decision around their valuation. As is demonstrated with the students, when this price is known, it does factor into a valuation. This phenomenon is commonly referred to as groupthink. It has been observed for a long time. In fact, a book was written as early as 1841 called The Madness of Crowds by an Irish author named Charles Mackay. Maybe in hindsight you should have called his book The Madness of Mobs, but in his book he identified that people tend to seek agreement and are willing to make pretty significant compromise in order to reach a quick agreement in a group. And those agreements tend to be extreme in nature. Another documented case around groupthink was in 1906 when an American statistician named Francis Galtor took some written down guesses that came from a county fair over the guessing the weight of an ox. And when he calculated the average of all the guesses, he noticed that the guesses were within 1 pound of the actual weight of the ox. Then in 2004, a book was written called The Wisdom of Crowds by James Surowiecki. Now, his book is not really implying that crowds are necessarily always wise. He wrote his book to point out that to have good outcomes from a crowd, two key things need to be present. One is that each member of the group needs to be independent of each other and have a diversity of knowledge about the subject matter across the group. So in the jelly bean contest, obviously you don't have total independence because as each student announced their guess, the next student, knowing that guess, factors it into their decision, resulting in a poor group outcome. In the case of guessing the weight of the ox, the farmers at the county fair were very knowledgeable about the subject, and each of their guesses were independent of each other, resulting in a good outcome. Now in the stock market, that as prices, particularly historical prices, are looked at and are known, that factors into consciously or subconsciously into the investor's mind as they think through a valuation. We can see how this groupthink reinforces pricing in the market and how this reinforcement creates kind of a topsy-turvy Alice in Wonderland kind of world where in the short term prices get driven to extremes, but in the long term they become more certain. And we'll be talking about that even more later on in this video. Also, it's where a contrarian, or better described as an independent thinker, will often beat the consensus of the mob. Following this approach, one must be prepared to look wrong for extended periods, meaning the mob can stay mad for a long time. John Maynard Keynes said it a little differently. He said, markets can stay irrational longer than you can stay solvent. To capture the phenomenon of groupthink, Keynes came up with the beauty pageant analogy for the stock market, in which participants try to anticipate who the judges will select. This is similar to what is now called game theory, where attempts are made to guess what your opponent will do. This sets up the stock market as a game of pure speculation. Benjamin Graham came up with the analogy of a voting machine represented by price in the short term and a weighing machine represented by value in the long term. Comparing it back to the Joel Greenblatt experiment, the voting machine is similar to the students announcing their guesses, and the weighing machine is similar to the students' written guesses. But Benjamin Graham felt that in the long term, the actual fundamentals, the sales, the profit margin, the inventory, everything that goes into a real company, that the real business value is eventually recognized by the market, but doesn't necessarily stay there. It could soon after drift from there and then eventually come back to value later on, drift from there. But the point is that it will eventually drift, albeit momentarily, to valuation. As stated earlier, long-term investment success is more certain than short-term success. So let's explore why this is true. In 1976, an economic professor from the University of St. Louis by the name of Hyman Minsky wrote a paper titled Systemic Fragility that discussed the instability hypothesis. He argued that stability is actually destabilizing. Stability leads to extreme optimism and in some cases euphoria. Enormous new risk is created from the void of current perceived risk, culminating in complacency and eventually a correction that humbles investors and clears the way for a recovery. This is often referred to as the business cycle. Let's discuss the business cycle a bit further. Over here to the right, we've been referring to the particular stock going up and down but follows a valuation trend line. Now think of this same line representing the overall market. And over here to the left is a graph created by Robert Shiller, economics professor from Yale. And it shows over from 1980 up through about 2010. And the green line is the valuation line that he's computed for the S&P 500. And then it shows how prices have moved quite a bit around that valuation. So instead of just a general view here to the right, this is a very specific view of the overall market. The green line is calculated by assuming that the market will return a historical average rate of return of around 10% annually, including inflation. Built into that assumption that earnings will grow at roughly the same rate as average historical GDP, which is reflected in the risk-free rate. It shows here that the overall market rate of return consists of the risk-free rate plus what's referred to as an equity risk premium. And this graph shows that over time, year to year, the 10-year Treasury bill, which is a proxy for the risk-free rate, and the implied equity risk premium, but it's got inflation. The graph has inflation built into it. So if we look at the historical inflationary rates, and then just mentally here, think of taking out inflation from the blue part of the line. What you'll notice is that you end up with an average of about 7% annually, excluding inflation. Now, in any given year, the real risk-free rate with inflation removed may be larger, and then the equity risk premium is smaller. But the two together, when the market's in equilibrium or kind of right where in balance where it should be. There are periods where not in balance, but when you're in balance, the market return will be a real 7%. And then the risk-free rate and the equity risk premium will vary depending where you are in the business cycle. But when you add them up, on average, they equal a real rate of return of around 7%. Down here at the bottom, we show calculation for price earnings multiple that we've gone through in other videos. But when you make the assumption that there's no, I'll call it accelerated growth in value, meaning that any earnings reinvested back in the company earns the expected rate of return of 7%. Well, then you calculate a PE multiple, which is 1 plus the rate of return divided by the rate of return. If you assume a real rate of return of 6.8%, consisting of a risk-free rate of 2.3% and an equity risk premium of 4.5%, then the PE is 15.7. Now, if we assume some inflation, but still no real accelerated growth in value, then you just have the growth being equal to the inflationary rate, and you can calculate PE with the inflation rate in the denominator. There is no reinvestment needs are required when you have inflation. It is your assets and earnings, everything is just growing by the overall inflation rate. And so if we assume real market rate around 7%, inflation of 3%, plug it into the formula, and we get 15.7. At the bottom here, we look at the actual price earnings multiple for the overall market over the last 40 plus years and calculate the average PE. You get the same number, 15.7. So regardless of the inflationary years, up and down, raise in treasury bond rates, lowering in treasury bond rates, historically the average is 15.7. See that the market maintains a real rate of return of around 7%. Now the Federal Reserve influences this by modifying the risk-free rate. When it sees the market overheating, it will raise interest rates, which causes investors to be more inclined to just invest in a treasury bond versus taking on risky projects. And before long, only low-risk projects are actually worked on outside of just investing in the risk-free rate. So as RF goes up, the ERP goes down. Vice versa, if the Federal Reserve feels that not enough risk-taking is going on in the marketplace and interest rates are too high, they'll start lowering interest rates. This will encourage companies to take on more risky projects. And therefore, the ERP will start to go up. And so you have this complementary relationship. Federal Reserve raises RF, ERP goes down. Federal Reserve lowers RF, it goes up. Now, it doesn't always go up and down in balance. There's a lag time between any action taken by the Federal Reserve and the eventual impact on the ERP. And that's why you see, variations down here in the PE, in the real calculation of PE from year over year. Now, many economists must say that using the actual PE calculation for the overall market is kind of distorted by any given moment in time. If you calculate the average price of the S&P 500 by its trailing 12-month earnings, you can get, if you're in a very expansionary period of the economy, you should expect PE multiple to go down if earnings increase as expected. When the economy is pulling back, if earnings decrease as expected, the PE multiple will go up. To give a little bit better indication of where you are at any given point in terms of the overall market's PE, Robert Shiller has come out with what is known as the Shiller PE ratio. It's also sometimes referred to as the cyclically adjusted PE ratio. And you can see here it over time. And there's a good write-up here on the gurufocus.com site that talks about the Shiller PE compared to the regular PE. But in the Shiller PE, what all they're basically doing is taking the current price of the S&P 500 and dividing it by the average earnings over the previous 10 years. And then it gives you a reading that's more reflective of the overall market cycle, an indication of whether, here the average is 16 to 25. So let's say that it's a little higher than normal, as opposed to the regular PE that we were showing here, that you could have spikes that would be expected based on where you are in the business cycle. So in summary, we've looked at Robert Shiller's trend line for the overall market versus this general graph we've been using to represent market going above, price going above and below an overall trend line. But then we've concluded that the PE ratio of 15.7 is a good benchmark to gauge whether the market is either in a contracting and their earnings are expectedly lower and then driving the PE higher, or if the overall market is expanding and higher earnings and therefore the PE lower than normal. Expect the market PE to be in the range of 12.5 to 20 with an average of 15.7. But it may be also worthwhile for you to, on occasion, to consider the Robert Shiller PE. Remember, because of the lag time between the Federal Reserve acting to either raise or lower the risk-free rate and the impact it has on the equity risk premium, you can see that the market rarely is on the line of true valuation. The business cycle causes investors' assessment of risk to continuously change. Most investors do not have a strong root of conviction because they lack a solid basis for reasonable valuation. Volatility makes investors skittish, emotionally reacting to news. Often markets are far from efficient, rather a whirlwind of emotion. This is not a defect of capitalism, rather a fact of human nature. Animal spirits cause spontaneous optimism, also known as Pollyanna, and a propensity for action. Successful investors have to reconcile themselves to the certainty of occasional dramatic short-term losses. Investors that attempt to time the market typically get out and back in too late. Investors that can endure short-term losses reap long-term gains. Now, it's clear that the fundamentals of a company, the inventory, the sales, the expenses, things like that that go into running a company, don't fluctuate nearly as much as prices. This reinforces that long-term value is different than short-term prices. As an investor, you can be assured that long-term value will prevail because in capitalism, there are high payoffs for successful risk-taking. So that will continually motivate investors to participate in attempts to reap the available rewards. Ambition, greed, and this general spirit of optimism will keep markets eventually in line with valuation as well. Also, there's unlimited human desire, so there's always going to be a need for markets, and long term, the value of those markets will be recognized by the marketplace. Also, is this the concept of mean reversion, that prices tend to get high, extremely low, but over time they gravitate around a valuation. Doesn't mean that once prices reach valuation that they just stay there. No, they continue to go up and down around. It's just that they tend to gravitate around a long-term norm. Now, the investor impact of this phenomenon of more guaranteed long-term returns than the short-term returns is that as an investor, you have to be willing to look wrong most of the time. Must be willing to endure being painfully judged for being viewed as being wrong. And you also must be comfortable with the idea of underperforming often and outperforming infrequently. Now, the hope is that the underperformance is relatively small, so you take a bunch of small underperformance, and then the benefit is over the long term you take large, infrequent outperformance. Now, to do this, you need to maintain sufficient cash reserves to ride through the inevitable downturns of the market and not be forced out. Well, so far, extreme price movements in the short term have been explained primarily by groupthink, or kind of the madness of the mob, and how following the crowd works well for many things, but not for investing. In addition to groupthink, there are many other human judgment biases or bugs that come into play. These human judgment bugs make it very challenging to make investment decisions that involve uncertainty. Now, to the bottom left is a brief discussion on the evolution of man. The first form of any kind of human was Neanderthal man from over 2 million years ago. Human-like cognitive abilities were designed for survival, to respond quickly to threats, and pass genes down to the next generation. It took several million years for Homo Sapiens to evolve, appearing around 130,000 years ago. The Stone Age ended just 10,000 years ago, a mere 300 generations. This is less than 1% of the time needed to evolve any significant additional cognitive abilities. Humans continue to modify their habitat extensively, particularly over the last 150 years, and are limping along to the space age with abilities designed for the Stone Age. The evolution of the human brain is exposed by the McGurk Effect, which is a multisensory illusion that demonstrates the human brain is divided into a legacy lizard brain and a relatively new rational brain. The lizard brain, which is also known as reflexivity or system 1, which pre-processes information before the rational brain, which is in the frontal lobes, it's also referred to as the reflectivity or system 2 brain, gets a chance to deal with the information. And this is why sometimes people will hear stories about other people and just say it just doesn't sound like that person. Well, people essentially have two different personalities. There's this one that, kind of lizard brain, the part of the brain that's right around the brain stem that reacts quickly to things. And then there's the more rational brain that primarily is in effect when a person is more calm. Also, behavior is contextual. People behave differently based on the situation. Now, lizard brain is designed to work more based on this stimulus and response. And you see that with other animals. That is referred to as nexting, which is not rational thought. There's just a memory of the last time the stimulus was received and kind of responses that worked out best. And so now when the stimulus is received again, it's just a very innate response to it. And now the human brain, having also this reflectivity, it takes a clue from the lizard brain and it has developed shortcuts, intuition, and heuristics that's not just purely stimulus response, but it is a form of nexting that says, hey, look, I've seen this before, this is what's worked in the past, and just blindly taking a shortcut and using a heuristic or just relying on intuition. And both these kinds of thinking, they're really centered around just a response to a known situation is dangerous, particularly as it comes into play for the investment world. In the upper right-hand corner are general human judgment biases that come into play when investing. I assume the viewer is somewhat familiar with these, so we'll not spend a lot of time on them. Presentism bias, this means that more weight is given to recent events in terms of recalling things. Hindsight bias, when thinking back on past events, information that is now known is interjected into those past memories, skewing memory of what was really known at the time, and therefore the event itself. Availability and effect heuristics both relate to more vivid memories are more readily recalled. Framing, often see this in used by salesmen. Example is in the mutual fund industry regarding their fees. Fees are discussed in terms of assets under management, but a more appropriate way to think of costs is in terms of the benefits. And if you're only getting like a incremental benefit of maybe a 5% additional return, but the fees are 2%, you're talking about a 40% cost versus maybe a 2%. So it's all on how it's framed. Anchoring, also used in selling. Think of in terms of the list price of a new car. Come into a car lot and see that, and that just sets the tone for future negotiations. It also comes into play in what we've already talked about in terms of groupthink, where the attitudes of the group influence the individual. All right, there's other biases here: confirmation bias, attribution error, belief bias. Let you quickly read about those. Other biases definitely come into play when you're dealing with investments. Things like overconfidence, thinking that you have some special insight. That is typically from little relevant short-term feedback regarding long-term goals. You also have representative bias, which is typically this is a small sample. Done this just a couple of times, you see the situation again, and you think that it's going to happen again. And so you see similarities where there just are none. This is particularly true with people that try out technical analysis, always looking for patterns from the past, thinking that the pattern will continue into the future, which in investing it rarely does. Then you get into information overload, and then what happens is investors will just start filtering out. Some use more intelligent filters than others, and some just flat out just chop out large pieces of information and just can't deal with it all. There's also a thing called conjunction bias, which is very common in the investment world, where you're looking at multiple things and you come up with some likelihood of event A and some likelihood of event B, but many incorrectly or their probabilities instead of ending them, thus arriving at a combined likelihood that is higher. You also have error of commission, which we've been talking about already in this presentation, which just means that people would rather do nothing than take the risk of being blamed for doing something that goes wrong. Survivorship bias, you see this a lot with back testing of financial models. They ignore companies that have gone out of business. You have loss aversion, and then more recently this prospect theory, which boils down to just means that people give more weight to loss than gain. There's more pain associated with a loss than there is pleasure with a comparable gain. Then cognitive dissonance. People tend to want to be viewed as being consistent, and that ends up with an escalation of commitment. Warren Buffett refers to this as the institutional imperative. Two important biases were left off the original recording, namely self-attribution and endowment effect. Self-attribution is when a person tends to take credit for successes but deflects failures or misfortunes onto others. This makes it difficult for investors to balance confidence with humility. A string of successes emboldens investors, enticing them to take ever-increasing risks. Endowment effect is related to self-attribution. This is where people tend to be emotionally connected to items they own, thus associating a higher value with them. In addition to basic human wiring, investors also struggle with investment models and skills required to use those models. Investment models tend to be very nuanced, have subtle idiosyncrasies and assumptions that really require that the models be thoroughly understood and know the limits of the models. Most models take some kind of inputs. Investment type inputs are typically concentric, which means they're interrelated and non-sequential. You can't just simply set input A and then set input B and then input C, because as you think about input C, it may have an impact on input A. So that's referred to as concentric. Also, you have protean, meaning that the relationship between things are not static. They're very dynamic. So something that you value, you use the previous week, previous month, maybe previous year, you cannot just continue to assume that the relationship between the values and the values themselves stay static over time. There's also this concept of is credited to George Soros, a hedge fund manager, that he calls reflexivity, where he argues that prices and investors' valuations impact the very fundamentals that valuations are based on, and this creates contagion. An example of this would be if through investors' valuation, prices eventually get, because expectations maybe are now lower, prices eventually start to drop. And now the banks assume that the companies are less able to fulfill their financial obligations. Thus, they raise the rate of interest they charge companies for corporate debt, which likely causes the stockholders to see more risk with future cash flows and demand a higher return on their investment. In addition to the models themselves, you have skills that are needed to make use of the models. Accounting basics, some financial literacy, statistics, and mathematics. So when you consider the required investment skills, nuanced models, bugs in human decision making, groupthink, and conflicting advice, you just end up adding so much to what is required of an investor in order to make good decisions about an individual stock selection. It's no wonder that investors at some point just feel overwhelmed and end up doing nothing. They would rather avoid a decision than feel remorseful about a potential poor outcome. Well, the consequence of doing nothing may have minimal impact in the short term, but in the long term, it can have devastating consequences. Doing nothing regarding your investments is a very hard habit to break. A study was done on people's choices around types of investments they make for their retirement. And it was shown that over 70% of people's retirement accounts have never had their investments changed throughout their entire working careers. So even those who maybe got around to making a decision earlier in their life, they never came back and revisited those decisions again. Now up here on the right shows the dire situation with retirement accounts as a result of investor inertia. 55% of workers have no retirement plan. People who do have access to a 401k, 20% of them don't even bother to sign up. 50% of baby boomers have $50,000 or less saved for the retirement. And then for all baby boomers, the average is about $90,000. It's estimated that over half the U.S. households can only generate $5,000 or less of annual income from their current investments. And over half the U.S. homes have a negative net worth. Well, this has resulted in 80% of people entering retirement have financial assets less than their home equity. The median savings for retirement for those 65 to 74 is a mere $125,000. But it's been estimated to retire comfortably, retirees need anywhere from $1.2 to $1.7 million in addition to Social Security. Well, to wrap things up, investor inertia may, particularly if you're in your 20s, may not be considered to be that impactful. But it has been shown it quickly, as you get out of your 20s and your 30s, it becomes essentially a death spiral with dire consequences. So that's the primary reason why the PolarisInvesting.com website and its free applications were developed. They give even a fairly novice investor a disciplined approach to take action to reach long-term investment goals. All right, thanks for watching.